Hi, I'm Jeff Tucker, Principal Economist at Windermere Real Estate, and these are the numbers to know right now. This month, I'll take a closer look at inventory, which is our best barometer of whether the market is trending in sellers' or buyers' favor. Nationwide, inventory is still working its way back up toward pre-pandemic levels, but at a somewhat moderating pace. At the end of June, there were about 1,083,000 active listings on the market, or 29% more than last year. That is substantial growth, but it is a step down from the 32% year-over-year gain we saw in May, which actually marks the first deceleration in this metric since December 2024. This could be a blip, or it could be an inflection point where we see that inventory growth start to slow back down. Now, that inventory growth has been swinging the pendulum of negotiating power in buyers' favor, putting downward pressure on sale prices. Going forward, if inventory growth stalls out, that could help to prevent prices from dropping much below year-ago levels. Now, the reason why inventory growth has begun to slow seems to lie with sellers. They came roaring into 2025 with a healthy rebound of new listings, but they've dropped off over the course of Q2. So if we just keep the last few years on this chart of new listings, we can see the year started as strong as 2022, with actually 436,000 listings in March, which matched the strong pace in 2022. But now owners have pulled back from listing as much. It's not a total seller's strike, but in June there were 15% fewer new listings than in June of 2022, or only about 6% more than this time last year. If this trend continues, sellers backing away from the market, it could insulate prices from declining, but at the cost of fewer transactions in the second half of the year. Turning now to the macroeconomy, the CPI report for inflation in June started to raise some yellow flags. The annualized monthly growth rate of prices jumped up to 3.5%, and the year-over-year change in CPI from last June was 2.7%. Now, shelter inflation has been a major contributor to elevated inflation for the last few years, but it's been decelerating, and that continued in June. In fact, shelter inflation ticked down to its lowest monthly pace in years at just 2.1% annualized. So the rest of the CPI basket, excluding shelter, is what drove inflation higher, back up to just over 2% for the first time in months. This rise in non-shelter inflation, especially inflation for other services beyond shelter, could lead the Fed to keep their rate cut plans on hold. So speaking of interest rates, it still feels like Groundhog Day, with 30-year mortgage rates bouncing around 6.75% yet again. There was a modest decline late in June, but that was erased by mid-July. Between strong economic growth, rebounding inflation, and higher debt issuance by the U.S. Treasury, I just don't see much reason to expect mortgage rates to fall dramatically anytime soon until some of those factors change. So this is still a higher for longer world when it comes to long-term interest rates. All right, that is all for this week, and thanks as always for watching.